Welcome in, everyone. Or rather, I should say, welcome to you, the learner.
The one who always wants to know not just what is happening in the markets, but why it's happening.
Exactly. You are exactly who we build this deep dive for. Today is Monday, March 9, 2026. And we've got a highly specific and honestly slightly mind-bending mission for today's session.
We really do.
Because right now, if you are looking at your crypto portfolio, you are probably feeling a distinct sense of whiplash.
Yeah, it's been a rough week.
So we are going to figure out exactly why the markets are suddenly stuck in the mud after such an explosive start to the month. But we aren't just looking at charts today.
No, we have to look much broader than that.
Right. We are going to show you how global geopolitics and literally the price of a barrel of oil are surprisingly pulling the strings behind your digital assets.
It's all connected.
And then later on, we are going to uncover a wild, almost unbelievable 17-hour window from just a few weeks ago where an infamous insider nearly rewrote the fundamental code of Bitcoin.
I'm so excited to get into that part. But it is the perfect agenda for today. Because to truly understand the micro-level movements of something like Bitcoin or Ethereum, right now, we first have to radically zoom out.
To the macro level.
Exactly. We have to look at global commodities, international conflicts, and the broader economic machine. You just can't really grasp what's happening on the blockchain today without understanding what's happening in the physical world first.
Okay, let's unpack this. Let's start with this current, incredibly frustrating market phase we find ourselves in right now.
Frustrating is the right word.
The vibe is essentially a market without momentum. For the past week or so, Bitcoin and Ethereum have just been drifting.
Yeah, just crabbing sideways.
Right. They are hovering below key levels and not really showing any convincing signs of strength.
Yeah.
Now, to be fair, Bitcoin did push close to that expected $75,000 mark right on schedule earlier in March.
It did. It hit the target.
But then the momentum just vanished, like someone pulled the plug.
That is the reality of the tape right now. And, the altcoins are feeling an even heavier pressure. The data we're looking at shows us that as long as Bitcoin isn't trending decisively higher, most altcoins are highly unlikely to suddenly break out.
They just bleed out.
Exactly. The market simply isn't showing any capital dispersion right now.
And for those tracking market internals, capital dispersion is just that phase where profits from Bitcoin flowed downstream into smaller, riskier assets, right?
Correct. Those flows simply aren't materializing.
And it seems a big part of why those flows are missing is coming from the traditional finance world. We are seeing continued outflows from the ETFs, and the broader macro backdrop is frankly quite hostile to risk assets at the moment.
It is. And what's fascinating here is the precise chain reaction causing this hostility. Our sources point directly to the ongoing conflict between the United States and Iran.
Right, which is obviously a massive global news story.
It is. Now, purely looking at this through the lens of market mechanics and staying completely neutral on the politics of the situation, of course, traders have rapidly shifted their attention and their capital toward oil.
Because of the supply threat.
Exactly. Over the past day, oil has begun rapidly outperforming almost every other asset class. We are talking gold, silver, and traditional stocks, all taking a backseat.
Yeah, I mean, we are seeing over $1 billion in volume for oil on decentralized platforms like Hyperliquid alone. It is massive.
It's a huge flight to commodities.
Now, our listeners know the general drill here. Oil spikes, inflation fears, return rate cuts get taken off the table, and risk assets like crypto take the immediate hit. But what is unique about this specific moment that has the market so spooked?
It comes down to the geographic magnitude of the risk. The absolute choke point for this conflict is the Strait of Hormuz.
Right.
It's a vital, very narrow waterway that serves as a key route for global crude exports. So even before a single tanker is stopped or a full shutdown occurs, the markets aggressively price in the risk of lower supply and soaring shipping costs.
They don't wait for the bad news to happen.
Never. Traders aren't waiting around to see what happens. They are front-running the possibility of a massive supply shock. And when financial conditions tighten under that kind of geopolitical stress, investors flee volatile markets.
They dump crypto.
Right. The sheer volume of capital flight specifically into oil right now is suffocating the momentum crypto needs to sustain a rally.
So on one hand, we have this massive macroeconomic weight pressing down on the market. But on the other hand, there's an entirely different theory for why the market is stalling right now. And it actually has nothing to do with the daily news cycle.
This is where it gets really structural.
Yeah, it has to do with time. There's a really deep analysis from Benjamin Cowan about what he calls the midterm-year simulation.
Yes, I love this analysis.
He's arguing that 2026 is acting exactly like past midterm cycle years.
Looking at the historical data, Cowen points to the 4-year cycle, specifically highlighting 2014, 2018, and 2022. He notes a very distinct, almost mechanical pattern that emerges in these midterm years.
And what is that pattern exactly?
It's a low in February, an early rally in March, followed by a harsh, undeniable rejection.
Which is pretty much a play-by-play of what we just lived through.
End of the week.
A February low, a tease of a rally pushing towards 75,000 in early March, and then a brick wall. Karen says 2026 is currently mirroring 2014 almost perfectly.
It is uncanny when you overlay the charts.
But why? What is the actual underlying mechanics of a midterm year that makes it so predictably disappointing for investors?
It is essentially a structural hangover. Think about the broader 4-year cycle. You have the halving year, which brings massive hype and retail influx.
Everyone talking about Bitcoin at Thanksgiving.
Exactly. The following year usually sees the parabolic peak. But by the time you hit the midterm year like 2014 or where we are right now in 2026, that post-halving momentum is completely exhausted.
The new money is gone.
The retail capital is totally tapped out. And the market is facing a reality check of tightening liquidity before the next major cycle kicks off. The crucial takeaway from Cowen's analysis is that this cycle structure is overriding the current macro narratives.
Wait, so you're saying the cycle dictates the price and the news just gives it an excuse?
In many ways, yes. While everyone is pointing to oil or ETF flows to explain the daily price action, Cowen argues that the market is simply following the average return pattern of prior midterm years.
That makes a lot of sense.
The news might provide the daily catalyst for a red candle, but the 4-year cycle provides the overarching architecture. Traders who ignore this structure, who constantly expect a new bull market to kick off prematurely just because of one good headline, are the ones who get chopped up.
Churned and burned. So for you, the listener, what is the actionable takeaway from all these competing forces?
It's a tough environment to navigate.
Honestly, the smartest move right now might simply be doing less. If we combine the defensive charts, the institutional net short positioning the macro headwinds from oil and this midterm cycle hangover, the base case, is a whole lot of sideways movement.
A lot of chop.
We might see another tease, maybe a pushback above the $70,000 area to trap some late buyers. But when that fades, the data suggests a deeper structural move toward the $50,000 valuation range is highly likely.
Which isn't necessarily a bad thing.
No, it's where Bitcoin begins to look fundamentally attractive again. Right now, in a midterm year, the name of the game is wealth preservation, not aggressive risk-taking.
I think that is a very prudent way to frame it. Patience is a position. Sometimes your edge comes simply from waiting for the underlying conditions to improve rather than forcing trades in a stagnant market.
I love that phrase. Patience is a position. But here's the thing. While the traffic on the crypto highway is completely stalled out right now, the construction crews are quietly working overnight to expand the roads.
They really are. The building hasn't stopped at all.
Let's transition into the infrastructure boom happening in the background because, frankly, it deserves way more attention than the daily price charts. First up, prediction markets.
Oh, this is huge.
Kalshi and Poly Market are reportedly targeting massive $20 billion valuations in new funding rounds. The trading volume on these platforms is absolutely surging.
Which makes perfect sense if you think about market psychology. When Bitcoin and major altcoins are just crabbing sideways, traders get bored.
They need something to do.
They still want to deploy capital, but they want volatility. Prediction markets offer that. Instead of betting on a token's price, users are betting on real-world events, elections, pop culture, Federal Reserve decisions.
Will the Fed cut rates next Tuesday? That kind of thing?
Exactly. The sheer volume flowing through these platforms is proving that decentralized betting and Oracle networks are finding massive product market fit entirely independent of Bitcoin's price.
That's a great point. And we are seeing major expansions in traditional crypto financial products as well. Coinbase just launched leveraged crypto futures for their advanced users across 26 different European countries.
26 countries. That is a massive rollout.
We're talking leveraged contracts on Bitcoin Ether and even new crypto equity indexes. The financialization of the space is accelerating, not slowing down.
And it's not just the products. It's the legal frameworks supporting them. The regulatory milestones are stacking up quietly but significantly.
Like what's happening in Florida?
Take Florida, for example. They just passed the first state-level stablecoin law in the United States.
Which is a huge deal.
It is. They've created a comprehensive framework for regulating stablecoin issuers, complete with standards for licensing, rigorous oversight, and consumer protections. And what's notable is how closely it attempts to align with broader federal guidelines, creating a legitimate sandbox for digital dollars.
We are also seeing some really fascinating nuance coming from the federal level itself. A new Treasury report just dropped regarding crypto mixers.
A very sensitive topic.
It is. Now, for anyone who might not be familiar, mixers are basically software tools that pool and scramble different streams of crypto together to obscure the original source of the funds.
Right, to give users on-chain privacy.
Historically, regulators have viewed them almost exclusively as money laundering tools. But this new report actually recognized that crypto mixers can serve perfectly valid, legitimate privacy purposes for everyday users.
It is a surprising acknowledgement. However, to maintain strict neutrality on the policy here, we must also note the other side of that report.
What else did they say?
In that very same document, the Treasury recommended new legislative tools that would allow institutions to temporarily freeze suspicious digital assets. So they are threading a very tight needle.
So acknowledging privacy, but asking for a kill switch, essentially.
Right. Acknowledging a user's right to privacy while simultaneously demanding stronger, more immediate tools for intervention when illicit activity is suspected.
Right. And what's interesting there is the overarching theme. When you look at the $20 billion valuations for prediction markets, the rollout of leveraged futures across Europe, state-level stablecoin laws in Florida, and the Treasury trying to balance privacy with enforcement. You realize that the institutional guardrails are being permanently installed globally.
Piece by piece.
This infrastructure is entirely paving the way for whatever the next phase of this market will be.
This raises an important question, though. We're watching external forces, governments, regulators, Wall Street, build guardrails around the crypto ecosystem. But what happens when the internal rules of the ecosystem are attacked from the inside?
Which perfectly sets up our final story today, because while the government and Wall Street are busy trying to regulate crypto from the outside, the foundational internal rules of Bitcoin were just put to the ultimate stress test by one of its own.
This is wild.
Here's where it gets really interesting. Let's rewind just a few weeks to February 27, 2026. This is the story of the 17 hours that tested Bitcoin's very soul.
It is a story that sounds like it belongs in a cyber thriller.
Yeah.
But it played out entirely in the open on the Bitcoin Core GitHub repository.
Okay, so you have got to walk us through this. Mark Karplus, the former CEO of the infamous collapsed crypto exchange, Mt. Gox, posts a code proposal.
Yes, right on GitHub.
And his goal is to recover roughly 79,957 lost Bitcoin.
Which is a staggering amount of money.
At today's prices, we are talking about $5 billion. These coins have been sitting completely dormant in a wallet known as OneFX since a massive Mt. Gox hack way back in 2011.
Just sitting there on the ledger, untouched.
Karpels wants them back to presumably make creditors whole, but how? He doesn't have the password.
Well, he didn't just suggest they try to brute force a password. He proposed a fundamental modification to Bitcoin's consensus rules.
He wanted to change the code itself.
Yes. He wanted the network to agree to a hard fork where these specific stolen coins could be spent using a special recovery signature. This would completely bypass the original private keys that currently lock the wallet.
I see the logic from a victim standpoint, but doesn't that contradict the entire point of cryptocurrency? He was basically asking the decentralized network to break its own immutable laws just this once to right a past wrong.
That is the core of the controversy. In a decentralized network, you can't just unilaterally change the rules. You have to propose a change in the code, and then the decentralized network of nodes and miners has to adopt it.
They have to agree.
Right. If a developer proposes a change like this recovery signature, and only a fraction of the network accepts it while the rest reject it and stick to the original code, you get a chain split.
Think of a chain split like a literal fork in the road where reality divides into two parallel universes. Suddenly, you don't just have one Bitcoin.
You have two incompatible networks.
You have Bitcoin version A, where the Gox coins are still locked tight, and Bitcoin version B, where the $5 billion has been magically recovered. And for you as an investor, a chain split is absolute unmitigated chaos.
It's a nightmare scenario for market stability. If a chain split of that magnitude were to happen today, the immediate result would be global exchange freezes.
Everything would halt.
Platforms like Coinbase or Binance would have to halt trading just to figure out which chain is which and how to credit user accounts safely. Liquidity would instantly dry up.
And people use a lot of leverage these days.
Exactly.
Yeah.
Because crypto is so heavily leveraged these days
Yeah.
that kind of deep uncertainty would trigger massive cascading liquidations across the entire market. It is a systemic shock.
But the crisis was averted. The proposal never even made it to the stage of becoming a formal Bitcoin improvement proposal.
Not even close.
Within about 17 hours, the developer community and the broader ecosystem completely shut it down. They closed the request on GitHub.
It was decisive.
It was framed as a massive victory for the concept of social consensus. The community essentially stood up and said no Bitcoin's immutability. The absolute rule that transactions are final and cryptography cannot be bypassed is vastly more important than recovering $5 billion.
It was a powerful demonstration of the network's resilience for sure. But if we connect this to the bigger picture, that 17-hour window actually exposed a vulnerability that goes far beyond rogue developers or decade-old hacks.
What do you mean?
The true threat exposed here isn't Mark Kerpelis. It is the reality of Wall Street and the new ETF era.
That's a jump. How does a GitHub code proposal threaten the ETFs?
It's the other way around. The ETFs threaten the resolution of a code proposal. Historically, in a chain split, the market decides the winner.
Right, the free market.
The chain that retains the most hash rate, which is just the sheer computing power from miners securing the network, and the most economic value from users, naturally becomes recognized as the real Bitcoin.
The winner takes all.
But today, the landscape is entirely different than it was even 5 years ago. ETF issuers, massive traditional asset managers like BlackRock and Fidelity now hold immense amounts of the actual Bitcoin supply on behalf of their clients.
But they hold billions of dollars worth of the underlying asset.
Exactly. So if a hard fork were to happen today, let's say over a controversial upgrade or a major recovery effort, these institutional giants hold so much centralized economic influence that they could effectively dictate to the market which chain is considered the legitimate Bitcoin.
Oh, wow.
They would choose which version their ETF tracks, and the rest of the market would almost certainly be forced to follow their immense liquidity. The hash rate would eventually have to follow the money.
That is a staggering shift in power. Wall Street could effectively play a kingmaker in a decentralized system, and there's a legal angle to this immutability debate as well, isn't there?
There is, and it is vital. Bitcoin has enjoyed a very specific legal and regulatory status in the US and globally precisely because it is viewed as a mathematically immutable neutral protocol.
Nobody controls it.
Nobody controls it. If the ledger is ever rewritten, even for a highly sympathetic reason like recovering stolen funds for victims, it sets a devastating precedent. Regulators could then easily argue that the network is not truly immutable, but rather subject to the whims of a centralized group of influential developers or asset managers.
If you can change it once, you can change it twice.
If the ledger can be rewritten once, it can be rewritten again. And that threatens the very legal protections that separate Bitcoin from being classified as a traditional security.
So what does this all mean? We have covered a lot of ground today. And for you listening, I want to tie this all together so you can see the matrix here. The core theme across every single source we looked at today is that the rules of the game are shifting underneath our feet.
Very rapidly.
In the immediate term, patience is your ultimate strategy. The macro forces, specifically the geopolitical tensions driving a massive capital flight into oil, are creating a hostile environment for risk assets. Those macro forces are currently overriding any positive crypto-native news.
And layered right on top of that macro pressure is the structural reality of the 4-year cycle. As we discussed with the midterm-year simulation, the data strongly suggests we are in a classic hangover period.
The post-halving hangover.
The post-halving momentum is spent, and we are facing extended weakness. It is a time to protect your capital, let the institutional guardrails continue to be built in the background, and observe.
Exactly. Observe how institutional influence is fundamentally altering the DNA of this space. They are driving the massive volume and prediction markets. They are shaping state and federal laws. And as that 17-hour GitHub drama proved, they hold an unprecedented amount of latent power over the very future of Bitcoin's code.
The Mt. Gox proposal was shut down quickly this time by the core developers. But the mechanism for a rewrite was exposed, and the entities with the financial power to potentially enforce a rewrite in the future have never been larger.
Which leaves us with one final, very provocative thought for you to chew on this week. We saw that the ultimate defense of Bitcoin's immutability relied on the social consensus of developers and the community firmly saying no to a code change.
But what happens in the future when the social consensus of those cypherpunk developers comes into direct conflict with the financial consensus of trillion-dollar asset managers.
If Wall Street eventually owns the majority of the circulating supply through their ETFs, do they eventually get to vote on the rules?
It might be the single most important question facing the long-term viability of decentralized money. We will certainly be watching how that power dynamic evolves.
And we will be right here to break it down for you when it happens. Thank you so much for joining us for today's deep dive. We hope you are walking away feeling sharper equipped with a clearer perspective on the macro and the micro, and ready to tackle whatever the markets throw at you this week. Stay curious.